Are you investing into an index fund and ever wondered what would happen if everyone just buys index funds? This question comes up a lot, and I can understand why it does. After all, a lot of the advice across YouTube and the investing community is to do exactly that.
We just buy an index fund and never look at a headline, never think about stocks.
But is this really a legitimate concern, and what exactly should we be looking out for? In order to break this down, it's important we start at the beginning, look at the fundamentals of what an index is actually trying to do. On a really basic level, all an index is essentially a list and then a ranking of different things using a given metric. Look at something like the Premier League, which is the top 20 football teams in England, and that's ranked by their performance over the course of a season. You could look at the music charts, which is ranked by the number of downloads for that given week. In the investing world, indexes are used to group together different asset classes, and they can be ranked in varying different ways. One of the most popular indexes is the S&P 500, which is the top 500 companies in the United States, and these are ranked by market cap, which essentially just means that they're ranked by the size of the company, so the value of that company. It's then also weighted so that the bigger companies get a larger proportion of the index. So if you have a fund that's aiming to track that index, it's going to put more of its money towards the bigger companies in that index. And one of the concerns that people have is that a lot of the performance with the S&P 500 is being moved by a really small number of companies. The tech stocks, specifically the Magnificent Seven, make up such a large proportion of that index, and they've grown massively in the last few years, and that's what's been dragging the index almost. We can see that with this chart here, which shows the concentration within the S&P 500 of the 10 largest companies and how their market cap has grown over the past 30 years. This was taken at the end of 2024, so it doesn't include the most recent correction we had in the past couple of months, but you get the idea. A lot of that concern is because it's based around tech stocks, and people are comparing that to the dot-com bubble, which in the late 90s, as the internet grew in popularity and the technology evolved, tech stocks massively grew in value. The problem here, and this is why it ended up being a bubble, it wasn't backed up by earnings, i.e. people were putting so much emphasis on these tech stocks continuing to grow that it just wasn't sustainable. And you can see that in the graph where you have a widening between the market cap and the earnings. And while there is still a gap today, you can see that the earnings per share of these top 10 companies is also at an all-time high. So although these companies have grown massively in terms of their share price, so have also their profitability and the earnings of these companies as well. This is important to note because what gives a company value is simply its supply and demand. And this is where the active market comes in. It's the same as any other good or service in the economy, whether it's a good in a supermarket. Oil's a really good example. So when there's less demand in the market, and the pandemic was a really good example of this, there was a lot less demand because people could do less. Oil prices dramatically fell. And then as the recovery came in and people could go back to work and back into the offices, people could use their cars more. Then there's more demand for oil and petroleum goods. Then the oil price started to recover. And this is a sign of how active the market still is. Looking at that graph, when we can see a correlation between the market cap and its earnings per share, that's what generally people are basing their decisions off. When a company is becoming more profitable, they're getting more earnings per share. That's when it's more likely to increase the demand and therefore increase its share price. When there's an increasing disparity between these two figures, that's when it can become an issue. But you've only got to look at the volatility of even these biggest companies to see how quickly they can change and to see how active the market is. Just look at the last couple of months off the back of Trump announcing tariffs across the rest of the world, how volatile the market was, how quick the market was to react. Every time one of these tech stocks have an earnings announcement, people are refreshing the page on the minute it comes out, because they want to get that information. They want to be able to have that information as soon as possible so they can make an informed decision. But why have index funds grown so much in popularity in recent years? We've only got to look at the data between active funds and passive funds to see why this is the case. The purpose of an active fund is to try and beat the market. And what this data here shows is that percentage of those funds that beat the market over varying time periods. The first thing to look at with this data, and this is what's quite staggering, over a 20-year period, this is looking at a blend of large US stocks. Only 8.3% of active funds beat the market over that time period. And as you can see in other time periods, it's even less than that. Active funds do tend to fare a bit better when you look at some of the smaller companies. If you look at something like the S&P 500, because it is so actively traded, it's such an efficient market. And that's why it's so hard to beat the market, because information is priced in so quickly. It's very difficult to have that edge. But one of the good things about the passive fund market growing is that it does weed out those bad active fund managers. And in the long run, what we'll be left with is those top active fund managers that are beating the market over the long run. They might not do it every year. In fact, that's virtually impossible. But the more data that we have, And the more people look at passive funds as an option and they compare that, not only the cost, but also the passiveness, compare that to investing into an active fund, I think people are a lot more aware and there's a lot more transparency information around now for people to make an informed decision. It's funny, when I hear that index funds are in a bubble, you've always got to take that with a pinch of salt and actually see where that is coming from. Usually if people are saying it's a bubble, it's because they want to sell you their expensive funds. But I don't think this is all bad for active fund management, because if you are an active fund manager and you can beat the market, you're still going to get assets in the fund, because at the end of the day, it's human nature. We want to beat the market, and people know, even though there's some risk involved, if there's a chance that we can get better returns, then a lot of people will take that risk. But just like anything in life, because the rewards can be so big, people are willing to take on more risk to get those higher returns. Just like top sports teams. The top sports teams in the world is such a minute percentage of the people that applied or tried out. But it doesn't stop people trying. Because the reward is so big, people are willing to give up their time. They're willing to make sacrifices on the small chance that they're going to make it. Same with people playing the lottery. They know that there's such a small chance of them winning, but they still play it anyway. People studying. People spend years of their life studying for something that they hope that's going to put them in a better position, but there's actually no guarantee that it will put them there. There's a quote with trading that 85% of retail traders lose money, but that doesn't stop people trying. Prop firms are as popular as ever. People deep down probably know that they can't really beat the market, but because the potential rewards are so big, they're going to give it a go anyway. And as much as I think passive funds will continue to grow in popularity, there will always be that active element there and people wanting to beat the market in the long run. If you are looking to get into index fund investing and you're not sure whether to go down the S&P 500 route or the global index fund route, then check out this video here where I break down the pros and cons of each of them to help you make an informed decision. I hope you found that useful, and I'll catch you in the next one.